All right. Good afternoon, my fellow capitalists and profit seekers. This is Rick Action Jackson, your growth stock guru. It is Wednesday, July 15th. Thanks for joining us. For those of you that are new, Wednesday is a day where I will comment on stocks that you out there have either emailed me or texted me, and I'll let you think what I think of them as far as a quality company or not, and then I'll also let you know if they pass my top quintile filter. I'm very strict on using my top quintile strategy for stocks I buy or sell. And one of the key aspects of the top quintile strategy is we only buy companies that have been beating what Wall Street expects them to report. Now, this is not advice. I am not a financial advisor. This is for education purposes only. If you like any of these stocks, please run them by your financial advisors to whether or not, from a risk perspective, they're appropriate for your situation, especially those of you that are beginners. The stock market can be a dangerous place. You can lose money. So ASML, they reported last night. There's been a lot of news in the media the last 3 days that gave the market a very positive tone. CPI, which is the consumer inflation rate, came in below expectations. The PPI, which is the business-to-business inflation rate, came in better than expected. And the unemployment report, it was weak. And the reason why the market likes that is that more times than not, when the Federal Reserve is raising interest rates, they're doing it because the labor market's red hot and the economy is starting to overheat. And as long as employment is a little weak, as far as new job creation, the Fed should behave themselves. So the market's getting confident that they're not going to, the Fed's not going to touch rates. And there was a fear that they might be. So that's causing a pretty much across the board rally. You're seeing all the major indexes up. And ASML reported last night, and they reported a blowout. And the stock's been up anywhere from $5 to $25 today. Right now it's up 11 and change, just under $17.90 a share. For those of you who don't know ASML, they are a Dutch company, but they pretty much have a global monopoly on lithography. Lithography is a critical step in building a semiconductor. You can't build a semiconductor factory in this world or this planet without ASML's equipment. It costs anywhere from $150 to $300 million per production line. Back in the 90s, there was an old joke that the only two people that knew when Andy Grove was going to build a new factory for Intel was his wife and the CEO of ASML, because if ASML can't send you their equipment, there's no point in building a factory. So ASML blew it out last night, had a huge upside report, and they've done that 2 of the last 3 quarters. They did miss 2 quarters ago because, they're shipping stuff at $300 million increments, and they booked the revenue when they shipped the equipment, and they missed the October quarter because one of the factories that were taking 2 of their pieces of equipment was the concrete wasn't done being poured. So no sense in sending the equipment there if there's no concrete floor. But they had a lot of very interesting comments, and all the semiconductors are rallying today because the CEO of ASML basically said that those of you on Wall Street that think this semiconductor cycle's peaking out this year, and usually these semi-cycles last 2 to 3 years, he said we're seeing nothing but the opposite. Their waiting lists to get new equipment extended from 18 to 24 months. They had a record number of new orders during the quarter. And he thinks this cycle is going to last at least another 2 years. Now, with all that good news, you'd think ASML would be up a ton. But let's go to the chart. It's up a little bit, but, it's really not up more than 1 or 2%, which for the type of quarter they reported, a lot less than I expected. And I think it's because Wall Street is very skeptical that this cycle's peaking out. This is the 5-year chart. So you can see ASML used to bounce pretty much between 500 and 750 for 3 years, and then it broke out, and it's more than doubled up here. It normally sells at a price earnings ratio of 35 to 40. It's at 60 times earnings on 2026 earnings and 40 times earnings for 2027. It's tough to make the argument this stock has a lot of upside. It's a great company. They dominate what they do. They had some of the best results that they've ever had last night reported. But this is how the Wall Street game works. It's not what did you do yesterday? It's what are you going to do tomorrow? And it's hard to imagine anything getting any better for these guys. Things will probably get less exciting going forward. And it's a good time for people who've owned the stock a long time to cash in and move on. So if you own this stock, you don't have to sell it. This stock could go higher. But as we say on Wall Street, the easy money's been made. The only way this stock will keep going up is they're going to keep on reporting blowout numbers. And there's only 40 major semiconductor companies in the world, and most of them don't make their own chips. There's only about 6 or 7 major manufacturers. These 7 companies can only order so much of this equipment, and right now almost all of them are getting multiple units every quarter. So everyone on Wall Street loves this. Everybody has got a buy recommendation on it, but who's going to buy it that doesn't already own it? If I owned it, I would sell at least half here. Maybe all of it. It could go higher, but I like to buy stocks that have a 3-to-1 ratio, meaning it's got $1 of down. For every $1 of downside, it's got $3 of upside. These guys report a bad quarter. I could easily see this stock falling to 1,500, if not 1,200. So you got, 30% or 500 points of downside. I don't see 1,500 points of upside in this stock. I see 500. Maybe 1,000, but I would sell some of it here. It's near an all-time high, and like I said, the results they reported last night almost couldn't be better. And it's not a cheap stock. It's expensive. So ASML, Giovanni, and Norwalk, I'd take the money and run. The next stock we're going to look at is Honeywell. Now, Honeywell recently split into 2 different companies. There is Honeywell Technologies now. It used to be Honeywell International. It's now Honeywell Technologies. And the other one is Honeywell Aerospace. Susan in Bridgewater, New Jersey, wanted to know if she should keep both stocks, sell both stocks, or sell one of them. Honeywell Technologies is the core business. It's a giant conglomerate. The best part of Honeywell was always their aerospace business, which they just spun off. Honeywell's one of these companies that constantly would pitch to Wall Street, we're going to grow our earnings 15%, and they would pull it off for 2 or 3 quarters, and then something would happen. Their businesses aren't really big growth businesses. They're good businesses, but they're not big growth. And the executives there know the game. If you want Wall Street to recommend your stock, you got to give an argument as to why you're going to grow 15%. But this company's very, very rarely been able to put 4 to 6 quarters in a row together of that kind of growth. So I would say sell Honeywell, HON. It's trading today around $222. It's about $30 below its all-time high, and they did beat the earnings the last 4 quarters. It's not an expensive stock, but it's not cheap. And I can't point to a reason why their earnings are going to be better than Wall Street expects, and that's a key ingredient for me to recommend a stock. But their aerospace division, which has been independent now for 2.5 weeks, it was spun off at 260, and it's fallen down here to 215. The aerospace industry grows faster than the economy, and Honeywell supplies all kinds of electronic equipment, cockpit equipment to both Airbus and Boeing. And I think this company will grow faster than the average company. And it's come down so much, it's pretty cheap. And that's not uncommon. When companies spin off subdivisions of the parent, you very often see stockholders sell the spinoff. And they don't really have much analyst coverage yet because if the bank was involved in the spinoff, they really can't produce any research for 3 weeks. That's a quiet period. So there's nobody out there bragging about this company, but it's a good company, and it's down $40 from where Honeywell spun it off. And it's not my favorite name, and I'd rather own Boeing than Honeywell Aerospace. But if I was going to keep one of these two, this is the one I would keep. So hold on HONA, sell on HON. Next one we have is Dell Computer. Craig in Fairfield, Connecticut asked about it. He wants to know if he should buy it. This would be my rule on Dell. Let's look at the chart. You see on the 1-year chart, this stock traded as low as $100 just 6 months ago, and now it's at $400. There's a lot of people that made a lot of money fast on this stock, and a lot of people are going to want to sell to cash out their winnings. That being said, Dell is one of the best run companies in America. Let's go to the long chart. This chart goes back 10 years. And Michael Dell is just a great manager. You can see 10 years ago, the stock was $11. Now it's at 400. Michael Dell is known for under-promising and over-delivering. In the 90s, he took the company private for 6 years because he totally restructured the company to focus more on corporate sales than retail sales, although they still do a ton of retail sales by mail. But that was all they did in the 90s. Now they bought EMC and they sell complete server and computer solutions to large corporations, and they dominate it. They, this used to be Hewlett Packard and Compaq's market. In 10 years, Dell's become number one. But he would typically suggest that Dell would only be able to grow 5 to 10%, and their earnings would grow 10 to 15%. He announced back in October, which is when I bought the stock for myself, that AI and NVIDIA's chips need a server, which Dell makes, to go in. And he said the orders for these NVIDIA servers were off the chart. So he was raising his growth rate long term from 5 to 10% on earnings to 5 to 10% on revenue up to 10 to 12. And he raised his forecast on earnings from 10 to 15 up to 15 to 20. And then the next quarter he reported was great. Stock went up about 40 points or 40%. And then in June, they reported a blowout. The stock flew. They first warned in May that the quarter was coming in better than they originally forecasted. And then when they reported the numbers, after the stock had already gone up 50 points, it went up another 150 points in a day. That's what we call a gap. It takes a while for the market to digest those kind of gains because a lot of people are just going to say, oh, wow, I'm up 300% in a short period of time. Well, let me take the profit. You've got to flush all those people out of the stock before the stock can really go higher. But I do think the stock could go a lot higher because in the 90s when Dell was growing 20%, it had a 40 multiple. In October, Dell's multiple was only 15 times earnings. So just going from 15 back to 40, you've got 150% upside right there. And their earnings forecasts have gone through the roof. They were originally forecasting $2 a quarter 3 quarters ago. They reported $5 for the quarter back in June. And now they're forecasting for next year. They're forecasting $18, which is probably low, but that's Michael Dell's style, under promise, over deliver. And if you put a 30 multiple on that, you're looking at a $580 stock. You put a 40 multiple on this, which is where Dell used to sell at when they were growing 20%, and you've got a stock that's in the 800s. So I do think this stock's got a long way to go. I personally sold 2/3 of mine. I'm keeping the other third long term. I would definitely hold Dell here for at least a third of the position if you wanted to take some off the table to protect your downside. That's a very prudent and understandable thing to do. I mean, if you've owned Dell for a while, it's probably become a very large part of the portfolio. On buying it, I would be patient. I would want to buy it ideally under 400. At 411 here today, that's not a bad price, but I'd only buy it if you're willing to buy more around 380, 375. Typically, a stock like this will kiss its 90-day moving average once or twice a quarter, and the 90-day moving average is 360. I don't think we get all the way back down to 360, but I do think this stock between now and its next earnings report, which will be in late August, it'll be late August, they'll probably kiss the 380, 390 level, and that's where I'd be more comfortable buying it. But again, there's going to be some selling pressure on it short term. Take advantage on buying it on a pullback, and if you own it, if it's over, I sold mine at 440. If you can get 420 or better, I wouldn't talk you out of taking some off the table here because, this boom they say is going to last another year or two, but they always say that at the top. I think it will, but it may not. So I wouldn't let this be more than 20% of your portfolio. I would shave it back to take some off the table. Okay, so Dell and Craig and Fairfield, hold some. If you don't own any, buy some here, only if you're willing to buy more lower. But long term, this is a good company, great balance sheet, great management. You could do a lot worse than Dell. Okay, our next one is Joby, Joby. Alex in White Plains asking about it. There are 3 or 4 companies out there. This is Joby Aviation, Joby. It's selling just under $8 a share. This company makes no money. This is speculative. I have 2 rules on speculative stocks. Number 1, I don't like buying speculative stocks with money you've worked hard to save because you're basically gambling here. And I don't want people to gamble. I want people to buy stuff where the odds are overwhelming you're going to make money. And secondly, I tend to only only buy speculative stocks with profits from other stocks. So if you're shaving Dell here and looking for a home for some of that cash, this stock would possibly be appropriate, but maybe only 2% of the portfolio. Go with your financial advisor the right amount. Second rule of speculative is that do not buy a speculative stock if you cannot afford to lose 50% of your money. Because if we're wrong, the downside here is probably at least 50%, maybe more. This company does not make money. If they're not making money within a year or two, they're going to burn through all their cash. But here's what I like about this company. There's 3 or 4 companies racing to provide basically helicopter service from downtown in the city to the airport. Now, this already exists, but the difference with this company is the helicopter is very small. It's basically the size of a car. And it can be piloted robotically. I mean, today, the helicopters, the blades are so wide, you've got to land it and let it take off pretty far away from buildings, and you've got to pilot. These guys, it's basically a robo-taxi the size of a car. And instead of having 1 propeller, they got 4 propellers on the 4 corners of the vehicle. And they already have 3 cities where this is up and running. Nobody else has a final product yet that the FAA is approving. Now, these 3 cities that Joby's testing it on, these are FAA trials. I don't believe they're taking passengers yet, but they are running from their agreed-upon liftoff point to the airport and coming back and logging, after they do 100 or 150 of these safely, the FAA will probably let them start taking on passengers. I do think in a lot of cities, people will be willing to pay $150 to get to the airport in 10 minutes. And that's this company's model. 150 for 1 person or 300 for 4. And they'll get you to the airport in 10 minutes. But again, they're not making money. They're going to be out of money in 2 years. There are competitors, but like I said, they're the first ones with a prototype in the market. Looks like they're going to be generating revenue within a year as long as there's no crashes. So Joby, this could be a very exciting stock once they get the FAA approval. Obviously, the stock would jump on that. But I wouldn't be surprised if in 3 to 5 years it's a $30 to $50 stock and it's at $7. So there's enough upside here to make it exciting. No guarantee this works out, but the fact they got a prototype that works and the FBA has given them a trial, they're halfway there to being on the market. And none of their competitors yet have an FAA trial going on. They're still working on the prototype. So JOBY, if you got a thirst for risk, Alex in White Plains, I'm not going to talk you out of this. It's not a buy under the top quintile strategy. We only buy companies that are profitable and have positive cash flow. But this one's interesting. It's interesting. I would treat this like rolling craps at the crap table. But it's probably got a 50-50 shot of working out. And for a speculative stock, that's not bad. Be prepared to handle the losses. No tears if it doesn't work. And lastly, we have Nick in Rye. He wants to know about CRM, Salesforce.com. This is a tough one. Let's go to the chart, and I'll try to tell the story reviewing the chart. This is the last 12 months. If we go back 5 years, I think it's even uglier. Yeah, it's really ugly going back to October of 2025 is when the stock peaked out, and that is when the SaaS apocalypse started. It's when Anthropic came out on October 6th and showed the world how you can verbally command Anthropic to make a piece of software, and it will do so. And if you want it to create a customer relationship management software with a lot of bells and whistles, it'll design it just the way you want. And Wall Street thought that these new AI platforms would put half the software companies in America out of business. And now Wall Street's figured out that that's probably not going to happen because these Anthropic softwares that they create, they're not very safe. They're easy to be hacked, and they're not. They don't work as smooth as the enterprise companies, which have tested these things over and over again and have got them to work pretty flawlessly. But the tough part on Salesforce.com is that they've got a lot of small companies and a lot of big companies. They're probably going to hold on to the big companies because of concerns about enterprise safety. But I could see a lot of small companies not wanting to spend $200-$300 a month per employee to be on the Salesforce.com platform and giving Anthropic one that's homemade a shot, especially if they're in a business where the data is not regulated, like medicine or accounting. Company has been unable to grow quickly, although they are growing. And they've been unable to beat the numbers big time, but they have beat the numbers. Now, the CEO of Salesforce.com, this guy could sell ice to Eskimos. He's saying, yeah, they're losing some small businesses, but they're adding a lot of agents to their platform. That's making people want to keep the software more and more. Agents are things you use AI for to automate tasks you do very often. And my guess is they're going to hold on to 90% or more of their enterprise clients with these tokens, and they'll customize them for their customers. But they're probably not going to be able to prevent losing a bunch of small businesses, and that's going to keep their growth rate low. The software industry is starting to see the stocks that are going to more benefit from AI than lose business, like Microsoft, like Workday, like ServiceNow. But the companies where the jury's still out, these stocks are dead. And I don't even know if Salesforce.com has bottomed out yet. The stock's super cheap, and they have beat the numbers the last 3 quarters. But they are losing businesses every quarter. They're getting more money out of their big businesses with the tokens. Will that growth outstrip their losses on the small business market? I don't know. I just think there's easier stocks to pick. That one's a quandary. It meets all the requirements of my discipline, except the chart looks awful. But I'm willing to buy a bad chart if I'm super confident in the fundamentals. And I like to have a reason why they're probably going to beat the consensus. And when I look at the fundamentals, I think it's more likely these guys miss the numbers than beat them because they've got to find a lot of new revenue on the big company side to make up for the small business side they're going to lose. I'd pass on Salesforce.com. Do you need to sell it here? It's really cheap. If you're super patient, these guys might figure it out and turn it around. I think there's better uses for your money. And if you're down and you have a tax loss and you've made a lot of money elsewhere, I'd probably take the tax loss to offset the taxes on the other stocks and put this somewhere where the chart looks good and there's less doubt on their growth. We can always come back to this stock when they've got an answer for how you're going to grow. But today, the argument that Benninghoff, the CEO, is making is a weak one. And there's a saying in my business, you don't want to be first, you don't want to be last, but you want to be in between. And right here, the stock's near an all-time low. If it does turn around, you're one of the first to believe it. I'd let someone else be that person and copycat them down the road when the chart confirms it. That's all we got for today, folks. Thanks for your suggestions. Use the email or the number below to send in your requests on who you want commented on Wednesdays. We'll catch you next week. Tomorrow we'll have 3 buys.